Hi everybody, good morning to you all. Thank you all for joining today, and welcome to the first of our accredited CPD courses taking place this year, brought to you by K3 Hub and Tolley. My name is Marie Wadeson, and for those that haven't seen me on a screen near you before, I am a Managing Director here at Quantuma, and on behalf of our parent company, the K3 Capital Group, I am also responsible for the K3 Hub. K3 Hub is a member network for professional advisors developed by us and other companies within the K3 Capital Group. Since we launched almost a year ago, 1,700 like-minded members across the country have joined the network. And through the K3 Hub, you can access a range of CPD and training sessions, not dissimilar to today's session, and also referral fees for certain types of work referred into the group. I am delighted to be joined by Jeremy Mindell today, who's going to run today's session. Jeremy is well known to the friends of Quantuma and the K3 Hub, and I'm sure he doesn't need too much by way of introduction, but here goes. Jeremy has been lecturing in taxation for over 20 years. He's well known on the speaking circuit as an accomplished and entertaining speaker. Jeremy is also one of the few individuals in the country who is a qualified chartered tax advisor, and also holds a certificate from the Institute or the Chartered Institute of Personal Development. Today, his session will broadly cover how businesses should remain compliant as HMRC looks to claw back COVID-19 grants, the pitfalls of claiming furlough funds and furlough mistakes, HMRC's powers, and also dealing with investigations should your clients be subject to one. A few pieces of housekeeping before I hand over to Jeremy and the team. The Q&A function is open, so do feel free to ask Jeremy questions as we go along. The slides are going to be uploaded by the team into the chat if they've not already been done so. We often get asked this question, but we are recording today's session and it will be available on the K3 Hub website during the course of sort of later next week. Before we get going, we have got a series of poll questions that will be coming up on the screen quite shortly. They primarily relate to today's session, and just one, if you wouldn't mind, to assist the team here to help shape the K3 Hub CPD webinar and training program for the year ahead to make sure it works for our members. And it goes without saying that we'd be grateful for your input. So we hope that you very much enjoyed today's session. And without further ado, I'm going to hand over to Jeremy and the team to get cracking for today's session.
Thank you very much, Marie. We'll start with the questions, and what you will see is that there's a polling question comes up. So the first question that I'd like you to answer is, in the next budget, do you think the Chancellor will, and it's a single choice, increase taxes, decrease taxes, or keep them about the same? And it just gives an idea of what you think about the way that tax policy will go. The second question is really a more linked to what we're doing in terms of today and compliance. So HMRC is putting more resources into investigations. The government announced extra funds for HMRC on that basis, and my belief is those funds will increase, particularly where the government comes under pressure in terms of bounce back loans and furloughing payments which have been given incorrectly, and where there'll be looking to be some clawback. So which area of taxation do you think will be the most heavily targeted? Do you think it'll be COVID related payments? Do you think it'll be employment taxes, corporate taxes, or capital taxes? And it would be useful if you would vote on that as well. You know, just a single choice there on that basis. Very useful for me is something that I always look at when I'm looking at compliance, is which area causes most difficulty for you or your clients. Again, a single choice of pay as you earn, national insurance, domestic corporate tax, so looking just at corporate tax issues in the UK, international taxes, that could be transfer pricing, diverted profits tax, dealing with other jurisdictions, VAT, or customs duties. Again, very useful if you put in a single choice there as what you find causes you most difficulty. Again, that always helps when you're looking at compliance. And then the final question that I've got from me is, do you think you or your clients will have issues on COVID support payments because individuals carried on working in the early period of COVID support payments, the first furloughing payments, individuals could not generally work and receive COVID support payments, although that did change later on, and they were allowed to do some part-time working. Secondly, then the employees were not notified in writing of any changes, and therefore, again, those payments could be at risk. The employees did not receive the COVID payment, i.e. the business took the payment without fully passing it over to the employees. The COVID payments have not been subjected to the right tax. So remember that they are a taxable receipt, or there's been a miscalculation on the payments due. So again, vote what you think might be the biggest problem in that area. And then the final question is from K3. So they have a number of CPD events during the year. This one is a multiple choice one. What topics, excuse me, are of particular importance to you at this current time? Is it tax? Is it regulation? Is it accounting and audit? Or is it practice development? That one is a multiple choice. So please do your choices. I'll give you about another few, sort of half a minute to think about your choices. And then hopefully I'll be able to discuss them after the first break. Just to say, while you're doing that, this course is due to last until 12 o'clock because my experience is that people need probably shorter but more frequent breaks from looking at a screen. We'll take a short break at around 10 of about 5-7 minutes, and we'll take another short break at about 11, due to finish around 12 o'clock. Okay, thanks very much. If we can take those away, that would be great. I'll just see what they've fine, good. Okay, so let's carry on. Those are the questions that we had. Just a short introduction about me. I used to be in, my background is in personal tax and shares, Big Four accountancy firm. I ended up a senior manager at one of the Big Four. I was then an in-house advisor to Henson Global Investors, spearheaded self-invested pension plans and transferring shares into them and dealing with share schemes, pioneered some financial education winning awards, and was head judge of the IFS Pro Share Awards for a number of years. So a mixed background of looking at personal and corporate taxes as well as share schemes and some financial education before coming full-time into lecturing and consultancy. Let's look at the compliance areas that are heavily involved within tax. So income tax is, I think, one of the big areas because income tax takes the lion's share of tax revenues. If you look at the size of the income tax hike, it is the biggest element, source of government revenues, followed surprisingly enough by national insurance, which is the second biggest. And of course, with the NIC rises that are due from April this year, April 2022, actually national insurance will grow in significance once again. Corporation tax, high profile, but actually raises considerably less than either income tax or national insurance or VAT, but again is due to rise in terms of importance to the government in terms of receipts, with the corporation tax rise to 25%, due in April 2023. Other areas of compliance, so the construction industry scheme, if you have a client or you are involved heavily in construction, you are often required to manage payments that go to subcontractors, either requiring them to provide you with gross payment certificates or deducting income tax at the basic rate on payments made to subcontractors. Other elements that you would look at would be international employment tax, where you have individuals seconded between countries. They may have a tax and national insurance issues, social security issues in more than one jurisdiction. Keeping compliance in that area is very difficult. And this leads to some of the issues in terms of pay as you earn, the checking that is done by HMRC on the records that and the processes that companies have in terms of pay as you earn. And then finally, one of the areas that has become, of course, very big in the last 2 years, COVID payments. I think it's over £30 billion worth of COVID payments. Jim Harrer, when he appeared at the House of Commons Public Accounts Committee, said that somewhere between 2.5% and 5% of all COVID support payments were probably made or claimed fraudulently, and therefore HMRC would be looking at trying to gain some of that money back, regain that money. What are the regular issues that you get in terms of compliance? What I've done is just really look at a few of the headlines, and we'll talk about how do you deal with them, because it's a very wide range of issues which come up. First one I would think of would be employment versus self-employment. You know, we've had lots of cases recently of, for example, TV presenters, medics, locums, others, where there is a question about whether they are employed or self-employed. And of course, the difference in terms of tax and national insurance treatment between the employed and self-employed make it very attractive for individuals to be classified as self-employed. They pay a lot less national insurance, only 9% class 4, plus a little bit of flat rate class 2, whereas the primary NIC of 12% paid by the individual and 13.8% paid by the company, due to go up by 1.25% in April, makes it very attractive for people to be seen as self-employed, much less costly, both to the individual and to the organization to which they're giving services. So therefore, it's a big issue. You've seen a lot of cases being decided on this in this area, and a number of cases still to be decided. And it's an area where I think it pays good rewards to look at the people providing services to your organizations and to see whether the regularity of what they are doing and the terms under which they are doing it is more likely to be classified as employment, and whether you need to look at the status and what you are doing on that basis. Because it could be extremely expensive if you have people who are claiming to be consultants but are really disguised employees. It is generally the end user, i.e. the person who is receiving those services, who would be liable for any additional tax and national insurance. Second element is payments through payroll, to make sure that unless there is a specific authorization, for example, that they are tax deductible expenses, that all payments are recorded in the payroll roll, that go through real-time information recording, and therefore subject to pay as you earn and probably national insurance. There will be tax-free payments, and the determination of what is a tax-free payment, you need to look at expenses. What is your expenses manuals say? Does it concur with HMRC's view about what tax-free expenses are? So, for example, for people working at home, they could get £6 a week at the moment, tax-free, in terms of a reimbursement for their expenses from working from home. There are other payments that can be made tax-free. So payments, for example, which go for travel to see a client or a customer or a supplier on business, that would normally be tax-free, but you need to exclude any normal home to work commuting. And that's areas that are used substantially looked at in terms of pay as you earn and expenses audits. You then get elements such as transfer pricing. So particularly where there is pricing between two companies which are in the same group, are they done on what is called an arm's length basis? What do I mean by an arm's length basis? I mean that if you were doing the pricing those goods or services between two independent companies, would you do them the same as you do them within the group? And if that is not the case, is there a transfer of value and therefore a tax consideration, particularly if one of the companies within the group is resident in a tax haven? We're coming up, excuse me, to the end of the tax year. And one of the things that we look at is the end of year calculations. So all the year to date pay tax deducted calculations that are required that make up the P60 for the employee, and indeed looking at the benefits that employees have taken in order to be able to prepare the forms P11D, say if it's car benefit, medical insurance, loans, those sorts of elements. Another regular issue that comes up is on expenditure, particularly for businesses. Is the expenditure capital or is it revenue? If it is revenue, you normally get a full deduction if it is for the purposes of the business. If it is capital, that is not the case, and you need to look whether you can claim capital allowances. You can claim capital allowances for plant and machinery, and at least for the next year and a bit until April 2023, there is the possibility of claiming the special rate allowance of 130% on plant and machinery, at certain plant and machinery, something that you might want to look at carefully. So capital allowances come into this as an area which HMRC check. Are you making the right claims? Are the acquisitions of capital that you are doing, either your business or your company or your clients are doing, do they qualify for capital allowances, and how are they treated? One of the other areas that is looked at very often by HMRC is what is called a Category X check for national insurance. What this means is that the default position is that everyone pays normal national insurance at the 12% primary rate, 13.8% is paid by the employer, otherwise known as the secondary rate. If you do not have a certificate, that is the default rate that should be paid for each employee. If you have a certificate, it could be that you are actually paying in a different category. So category C would be for employees above the state pension age where no primary national insurance is due. It could be a category X because maybe your employees have come from overseas and are actually subject to national insurance in the country where they normally reside. It's very important. There may be age considerations. So, for example, for younger employees, i.e. those under the age of 21 or those in an apprenticeship up to the age of 25, again, there may be a reduced rate of national insurance, but it is important to substantiate why you're paying less than the normal rate of national insurance. And then finally, well, not least, but one of the areas that comes up would be share schemes, where you have share schemes run by your company or your clients. Is the correct amount of tax being accounted for when the options vest on those share schemes or shares are delivered to employees? If they're in a tax advantage plan, there may be no tax or national insurance. If they're in a non-tax advantage plan, so a normal share scheme, there would normally be tax and national insurance, sometimes even if the individual is not being given the cash, but is just given the shares and needs to fund the tax and national insurance themselves. So there's a huge list of things, and you could go to almost any website to look at compliance, and you can see a huge laundry list, checklist of things that could go wrong within tax, whether it's to do with corporate taxes, VAT, national insurance, pay as you earn, share schemes, transfer pricing. So what do you need to prioritize? How do you prioritize? And I think it's really important that you look at a number of questions. You cannot look at everything. It would be impossible. It would be both undesirable because you would be using more resources than needed. And secondly, it's not practical. Effectively, when you think about compliance, there is a cost to it, either in terms of time, well, certainly in terms of time, but also in terms of the professional costs. So when you're looking at compliance, what is a reasonable basis to proceed? Well, clearly that you need to think about, is this area material? So in other words, is it a significant amount of money? You know, if it's tuppence halfpenny, it may not be an area that you need to look at. You want to look at the areas that are material to the business. It could be that it's an area that affects other areas. So you've got a tax problem in terms of the recording of the car mileage. That could be affecting not only the petrol receipts claims, but also indeed the travel and subsistence claims. If you're not monitoring where your employees are traveling as they restart traveling on business. And a good example of this would be where you've got employees staying in another country for a significant period of time. You need to know that not only from the employment tax perspective, in other words, do they end up with a tax withholding in another country? Let's say I send an employee to Denmark. Will there be tax withholding in Denmark? But also, do the employee's activities, are they sufficient to create what I call a permanent establishment, which might give you a corporation tax filing requirement in Denmark as well? You also need to look at reputation. So in other words, have you got an issue which is going to cause you significant issues, potentially if it came out into the public domain? So a number of companies have been embarrassed by their CEOs claiming expenses which they definitely should not have claimed. And companies have been hugely embarrassed by that when it's gone into the public domain. And also look at what risks can be controlled. The traditional way of doing this is what is called a heat map. And what you would do is look at a collection of issues, and looking at the factors that I've talked about before in the previous slide, you create what is called a heat map. So in other words, have you got a situation where you've got certain items which are green, which means that you are comfortable, fairly comfortable with them? Are they amber, where they need at least a watching brief and potentially an intervention? And then finally, the red items, where there is a real problem because you believe not only is there a substantial amount of money at stake, there is a real risk of tax loss and other issues coming out. And thirdly, the control functions for that area are insufficient. And a heat map is something that would allow you to prioritize which areas are you going to spend your limited resources. The heat maps, as I say, tend to be based on the size of the issue, the measures that need to be taken to deal with it. And the other element that you would want to look at would be, have there been previous audits? Have you promised HMRC, for example, that you would take corrective action in that area? And if you haven't taken corrective action, then if they come back and find that the problem remains, they are likely to invoke much higher penalties. So when we look at the first steps in terms of compliance, looking at an overall picture, deciding what to prioritize, you can't look at everything. You do need to decide where you put your priority, where you put your resources. So in terms of what is the good foundations for compliance, I would start off, and this comes really from what HMRC, Her Majesty's Revenue and Customs, would look at when they do an audit. That could just be a review of procedures, or it could be a full-blown audit. And what they look at here would be a good foundation is accurate records. You know, under tax legislation, you need to keep records for 6 years from the end of the tax year in which the transaction takes place. Accurate records are the foundation stone of good compliance. You need qualified or at least experienced staff, and HMRC in their visits will often look at what sort of quality of staff do we have, how far are they actually able to deal with the transactions. If you've got, for example, within a company, somebody who has no real idea of the tax treatment of benefits and expenses, processing this, then you may have a significant problem. If you have people dealing with international assignments who have no clue about when business travel becomes a tax challenge in another country, then of course, again, you're likely to have a problem. So you start with accurate records, you go on and look, do you have qualified or experienced staff? Next, they're going to look at what is the culture of compliance. So do we have a compliant culture? Do we have something whereby what we're looking at is a company that looks to succeed in keeping its compliance accurate, where individuals are not looking to game the system, but are actually looking to comply with the company's and tax rules, whether that is on benefits and expenses or whether it's on compliance within pay-as-you-earn. That then leads to strong compliance, tax compliance, and that would always be part of a strong overall financial strategy. What you tend to find is that if there is a weak culture of compliance in one area, then you tend to find it is not isolated. It tends to spread throughout the operations. One of the things I always say to people is that HMRC often start by looking at benefits and expenses. Where they find a company where the benefits and expenses rule, particularly the reimbursement of expenses, is not being properly controlled by the company, that gives them a view of the company that it is weak on its controls. And that informs the way that they look at the company as a whole. So I always say to people, start off by looking at your benefits and expenses, because it is really HMRC's window quite often onto the company. Other elements I'm going to look at is the pitfalls in claiming furlough funds and other support, HMRC's powers, as Marie talked about, other powers acquired by HMRC, particularly in terms of public licenses, and how to improve and focus your clients' compliance activities. and how to deal with investigations. The sort of mistakes that have been made, some of them deliberately, some of them by accident, and it's an area where there will be a huge amount of both public and political pressure for HMRC to recover those amounts. At the beginning of the coronavirus pandemic last 2 years ago in March, there was an emphasis on getting money into companies' hands and therefore into employees' hands very quickly. And so therefore compliance was put very much as a secondary element to getting the money into people's hands quickly. And that meant that there was plenty of opportunity for payments to go to the wrong hands. And the sorts of elements that you had were mistakes of non-existent employees, working employees, non-payment to employees where payments were made and not passed on to employees. It was still a taxable payment, may not have been included in real-time information in your pay as you earn, and it is a taxable receipt, and a non-inclusion in the corporation tax computations again would be a problem. It was extended to the 30th September 2021, and there were a number of different phases of furloughing payments. A reminder that from July 2021, businesses had to contribute more. The maximum grant dropped to 70% of salary, but businesses had to pay 80% to the employee. In August and September 2021, the maximum grant dropped to 60% of salary, but again, 80% had to be paid to the employee. And I think it'll be a standard position for the next few years that HMRC will be looking very carefully at those elements. The standard basis that happened before the payments drop would be an employee earning $2,000 a month agrees to a furlough period of 3 months. Remember that the employees had to agree to the furlough under the job retention scheme. When it was the 80% payment, the government would cover 1,600 of the 2,000 contracted gross pay. The employer then puts the 1,600 gross pay through their payroll and pays the resulting net pay to the employee, and the employer would suffer the employer's NIC payable. So that was when the government, the early stages of furloughing, and you need to think about the different conditions. At the beginning, the employees were not allowed to work part-time, even part-time for the company. It was either full furlough or no furlough. And that will be something that would be checked up on. For example, there was an employee helpline where employees could report companies who claimed furlough but still insisted their employees worked. Capping, where an employee earns $4,000 per month, say, then the government covered $2,500 per month. The 3,200, 4,000 times 80% is capped at 2,500. Employers would have needed to identify their furloughed employees and notify these employees of the change in their employment status. Changing employee status in this way is subject to existing employment law, and depending on the employment contract, could have been subject to negotiation. So a number of factors which I'm not sure everybody appreciated: the requirement to get employee consent, the importance of putting the money through the payroll as being taxable, the capping on the amount that the government would give. All of those elements may have been overlooked in the rush to get furloughing payments. There were also other elements that came in. So what you had was a retail and hospitality schemes with grants given, particularly where those businesses were badly affected. And it was the same properties that are eligible for the business rates holiday were eligible for those grants. Again, those grants are finished, but HMRC will now be checking that those grants were given to the right businesses. And then almost as a very big breakthrough, very different to any support that had been given before, support was being given to the self-employed, the SEISS, the Self-Employed Income Support Scheme. So there, the self-employed and members of a partnership eligible, provided the business has been adversely affected by COVID-19. The original SEISS required them to have submitted their 2018-19 tax returns by the 23rd of April 2020, traded in the year 2019-20, are trading when they apply or would be except for coronavirus, intend to continue trading in the 2021 tax year, and lost trading profits due to coronavirus. Now, that was the early SEISS compliance, and notice the requirement to promptly do tax returns. The difference with SEISS was that under the coronavirus job retention schemes, individuals could continue to work or take on other employment as well as voluntary work. The trading profits could not exceed 50,000 and half the total income for either the tax year 2018-19 or the average of the tax years 16, 17, 17, 18 and 18, 19. So I think fairly obvious that this was always going to have more strings attached, looking at people whose trading profits were below £50,000, also comparing their profits with 1 year with the averages of other years, and so therefore a number of calculations to be done. You should also note that when the SEISS is received, it then becomes taxable. And again, there were 5 different SEISS awards with different rules to them. One of the elements, as I said, was the allocate the grants to the tax year when received, not necessarily the tax year when applied, but actually when received. And that could cause issues if you have other income, variable income. You could find that there is more tax to pay on the SEISS in 1 year, but very little income in another year. So you could end up, say, 2019-20 with very little income, and 2021 with quite a lot of income, because that's when you received your SEISS grants. The other element is that for the latter grants in SEIS, there was a 30% cliff edge in turnover calculation. So an additional condition was put in terms of turnover. The 4th grant, covering the period February to April 2021, 80% of the fall in turnover, maximum £7,500. For the 5th grant, covering the period May to September 2021, so this is after, if you like, the resurgence of COVID, and therefore extra measures were announced, you would had to claim from late July 2021. If the turnover has fallen by greater than 30%, you would get a claim based on 80% of profits, a maximum of £7,500. If turnover has fallen by less than 30%, you would look at 30% of profits only, subject to SEIS, 30% of the fall, a maximum of £2,850. The other element was that the original SEISS grants were not available for people who just started their businesses, but the 4th and 5th grants were available for businesses who started in 2019-20, and if they'd filed a return up to the 2nd of March 2021, could claim the 4th and 5th grants. And Finance Act 2021 amended the law so that grants are taxable in the tax year received. The original law said they would all be taxable in 2021. So you can see there's quite a lot of work in terms of SEISS. If you have clients who've claimed it, you want to recheck the position regarding the turnover, because that would affect the fifth grant. You would also want to check when the grants are received, because that will affect when they have to declare them for income tax purposes. So again, quite a lot of work, and you will expect that HMRC will, as part of their standard inquiries into compliance, will be looking at this on a regular basis. If people have any questions, they're happy to put them in the chat box, and I'll look at them later on. But this is an area where I think if you are advising clients, there needs to be some sort of check of what they've claimed and on what basis, because sooner or later, HMRC will be looking at the companies and individuals who've made significant claims to check those claims. And as I say, you need to check the different qualifications in terms of employees, payments, and profits that have been made. Moving on to another subject, let's look at national living wage. And what you can see in terms of the national living wage is that there's been a significant increase in the NLW and the national minimum wage. Important, again, that you keep track of the ages of your employees. You should have those details, of course, because you would need some document which shows that they have the right to work and live in the UK. That's either going to be the relevant page of their passport, if it's a UK passport, or relevant documentation showing they have a right to work in the UK, or their birth certificates. So when you look at that, what you can see is, again, you're looking at a substantial increase, and therefore on that basis, individuals need to be paid the right amount, at least the right amount, in accordance with the rules on that basis. So these increases coming in April 2022 are going to be something that HMRC will police quite carefully. What can go wrong in terms of the national living wage? One of them elements would be time recording. So time recording, I think, is one of those areas you think, well, I'm paying somebody, you know, a figure of £9.50 an hour. But if the time recording means that actually they're working for 8 hours rather than 7 hours, then you're not paying the right amount in the national living wage. That could be because maybe in terms of if the individual needs to travel, not commuting travel, but any other travel to suppliers, customers, or in the course of their work, that needs to be included within the national living wage or national minimum wage. So all the travel, excluding commuting, will generally need to be included in the time on which you pay the national living wage or national minimum wage. If they're in the hospitality business, one of the issues comes up is that you cannot include tips in the wage. So a waiter or waitress receiving tips, that is in addition to the national living wage, cannot be included within there. So you need to pay them the salary, tips are on top. Not including security time. So where you have, there were some well-publicized cases of warehouses which had quite intricate security measures, which meant that employees were spending an extra 20, 30 minutes being checked before they could leave the premises. They need to be paid for that time if they are subject to, say, security checks on entering or leaving premises. And then getting the wrong age of employees, you should know as an employer the age of all your employees. You have access to the relevant documents, and paying them the wrong rate because you've got the wrong age is not an excuse. So that's an area which I think there's going to be a greater and greater focus on, particularly as the government looks to raise, as you see, the national minimum wage and national living wage above the rate of inflation. Another element which is coming up in terms of compliance is an area that I want to, I think will expand, is that one of the tools that HMRC is looking to enforce tax compliance is to look at the public sector. The public sector gives lots of licenses. So licenses to drive taxis, private hire vehicles, to operate a private hire vehicle license, dealing in scrap metal, all need licenses. And if individuals or companies fall behind in terms of their tax compliance, they will find that they will be denied licenses. And this is an area of conditionality that I think will only grow and grow. Any companies or businesses that work in an area which is dependent on a license being given by a public sector body may find that those licenses will be refused if their compliance record is not up to date. This is a tool that HMRC has been talking about for about 6 or 7 years. It is now in law, and I expect it to be expanded over the years as part of HMRC's efforts to improve tax compliance. So any clients who rely on public licenses given by a public sector body will need to make additional efforts to ensure that they're tax compliant in both terms of reporting and in terms of payments. Another element that has come up during COVID-19, the government suspended interviews for customers applying for a national insurance number. Now they have ended that. Going forward, everyone applying to register self-employed must obtain a national insurance number before registering by applying online. Individuals who have registered as self-employed without a national insurance number must now obtain one. So it's an area where they've ended some of the relaxations for registering for self-employment. So getting a national insurance number is now going to become requisite once again. And what you will see is, as the government has just announced, the probability that all restrictions will be ended by before the end of February, you will again see some of the relaxations which HMRC have given through the pandemic will be ended. And it is worth looking out for those notices where you like these, which say we're now back to normal business. Let's look at some of HMRC's powers. What is the environment in which they are working? Remember that HMRC can make assessments on a company, on directors, and on employees. And you would look at, first of all, at where does HMRC have, where all their powers in terms of investigation sit? Well, it sits in legislation. The core of it is now over 50 years old, but of course has been changed over the years. Hence, you will see 9A. So this is TMA, which is the Taxes Management Act 1970. So HMRC's powers are consolidated into that act, and any additional powers or changes would be put in a Finance Act, say Finance Act 2020, and then would be slotted into Taxes Management Act 1970 so that you can conveniently see them in the same place. 9A is very common. It is HMRC's power to inquire. It's not a a power to ask for information or documents. It's a power to inquire about your tax position. What is the ability to open an inquiry? So section 9A2, the time limits. If a tax return is delivered on time, it's 12 months from the day delivered. If the tax return is delivered late or amended, it's the quarter day following the anniversary of delivery amendment. The date of receipt of the return is relevant, not the date that it's posted if it is done by post. So generally speaking, that gives HMRC carte blanche to inquire into anything within 12 months of a receipt of return. So, for example, all the self-assessment returns which were submitted by the 31st of January 2022, HMRC has until the 31st of January 2023 to open up an inquiry, and it needs no reason to do so. What is the scope of the inquiry that they do? What do they have to ask? Well, they can ask about anything contained in the return or required to be contained in the return, including any claim or election included in the return. And in terms of amended returns, when can no longer inquire into the whole return, the scope is limited to matters to which the amendment relates or which are affected by the amendment. So in other words, if you amend a section of a return, that then restarts pretty much the 12-month on the section of the return that is amended. Separately, they have under Schedule 36 of Finance Act 2008, the power to ask for information or documents. And they can notices in writing requiring a person to provide information or to produce a document. And the words that are really important in this are reasonably required. Are they reasonably required for the purposes of checking the taxpayer's tax position? That reasonably required is supposed to stop them just asking for anything. So in terms of that reasonably required, what information can be requested? What is reasonable? Those are the sort of questions, what is a document in a person's possession or power? And what must you do if you receive a Schedule 36 notice? Now, all these points are clear. You want to have a full record of documents for relevant transactions for 6 years. When we're looking at what is reasonable, there are restrictions. HMRC cannot ask for everything. They can only ask for elements which are relevant to the tax investigation. Moreover, they can only ask me for my records. They can't ask me to get records of my wife or my children or my parents or the company for which I work. They can only ask me. If they want documents from my wife, my children, my parents, or my company, they have to send an information notice to those relevant people or organizations. It also, as I say, needs to be reasonable. And that gives you an inherent restriction on information powers. You cannot request documents from a tax advisor on advice about a person's tax affairs unless the advisor helped in the preparation of the return and the document explains how an entry was arrived in. You can request from an individual, but it's rarely relevant to checking a tax position. So when you receive those sort of requests, you do need to think very carefully about the scope. You can't ignore the request, but you are, and you should, if you are discharging your professional duties, work out, does HMRC have a right to those documents? What are the common themes about this? So common themes would be that HMRC may try and carry out an informal inquiry. This is what is known as nudge letters. We've seen a lot of nudge letters over the last couple of years. It's very easy for HMRC to take a trend, think that somebody's invested in a particular industry, say the film industry, and will send out nudge letters. These are non-statutory letters. You have no obligation to answer them, but if you don't, the likelihood is that they will start with a formal investigation. But they do send out a large number of these, and it is important to understand the difference between a nudge letter, which says, we think you may have something wrong with your rental income or your investment income, and a letter which starts an inquiry. That might be carried out over the phone if a simple matter, discussing apparently obvious errors or missing information. May want to understand business or perceived risks. So it may be that it's actually better to head off a simple inquiry at the pass before HMRC gets too committed in terms of time and effort. If there's a simple misunderstanding, better to correct it rather than lead HMRC into the path of a full-blown investigation. Elements that you need to think about in terms of any information requests. Obviously, your duty of confidentiality to your client, and HMRC can only formally inquire once. If informal, obviously an inspector can open one later, and further fees may need to be then charged. The other element which comes up is what is known as the discovery powers. So I talked about the 1 year limitation on HMRC opening an inquiry, but this is extended by the ability to open a closed year if HMRC have discovered something is not correct. It's an assessing power, not an information power. And it's something that is not correct, that was not obvious to, or should not have been obvious to, a reasonably competent inspector when the tax return was put in. So a lot of people put information in the white boxes of tax returns to cover a contentious point, so that they can say HMRC has had sufficient information and therefore they should be bound by the 1 year limitation. But if information is not available to HMRC and they discover something later on, then there are different time limits that they have. So if there's been an error or mistake by the taxpayer 4 years from the end of the relevant tax year, if it was careless as well, and an error or mistake is not always careless, the courts have seen a lot of errors and mistakes that are not careless, then you look at 6 years from the end of the relevant tax year. If it is non-UK, then it is 12 years for offshore matters. And if it's deliberate, then it's 20 years from the end of the relevant tax year. So if you've got deliberate fraud or negligence, then it's 20 years that you have to wait until HMRC cannot assess you. I once had an investigation where we were looking at a client who hadn't put in a return for 21 years. So for 20 years, HMRC collected the money. For the 21st year, they said, well, you know, sort of, we don't have the power to collect the money, but you can make a voluntary payment of tax if you want. You can imagine the client's reaction to making a voluntary payment. Common themes, straightforward matters, particularly in tax returns. You're looking at missing bank accounts, missing employment income, checking all income has been reported, particularly reinvestment of disposal proceeds for capital gains tax. Obviously, HMRC's digitization, which has been slightly delayed because of both COVID and also the reallocation of resources to deal with the new customs arrangements and computer systems after Brexit. We expect that to go back to their digitization program. Of course, there is plenty of information that you can now get on the Fetch system. So where you are an authorized agent, you can get the employment information direct from HMRC. But it doesn't mean that there won't be missing information. As I say, focus on making sure you get the easy bits right, and making tax digital may eventually assist in this, although one is not sure. Obviously, there are more complex matters, UK residency. This is of particular interest both to the individuals traveling, but also the companies, keeping track of where their employees are going. Now, clearly, some employees, most employees have not been traveling a great deal whilst the borders have been shut, but this, travel is reopening, and keeping a track of where business trips are, where people are spending substantial amounts of time, will be a significant issue. If you've got overseas workday relief, where people are coming into the UK and claiming relief for time spent overseas and apportioning their income, you need to look at that. Things like remittances to the UK, termination payments, foreign tax credit claims, and incidental versus substantive work days. If I go to a place, is it only incidental, I'm just doing a business trip, or is it a substantial piece of work, which means I may get a tax liability in that other country? Those are all themes of inquiries and areas where you need to think about compliance. And we'll now take a 7-minute break. So we'll be back at 10:10. And I'm going to look at best inquiry practices, how to deal with those, as well as some other tips on compliance. So we'll be back at 10:10. Okay, so before I carry on with best inquiry practices, just want to look briefly at the polls and the answers that you gave. In terms of the COVID payments, people are pretty split on the two major elements that they think will be a problem, were employees carrying on working and receiving COVID payments, and a miscalculation. I think to deal with both points, you need to deal with each, particularly for the CJRS, the furloughing payments. You'll need to segment them into the different stages of the furloughing payments and the different conditions. As I say, at the beginning, employees were not allowed to work at all for their company and receive COVID payment, furlough payments. That changed as the system evolved, and some part-time working was allowed. So important to differentiate between the two. In terms of the miscalculation, I think it'll be important to see the 80% rule and checking when it becomes 70 and then 60%. Again, looking at the different stages of the COVID payments and separating them out. You can't take the total amount. You're going to have to look at to which period it referred and how the payment was calculated. And I think that for almost most of you thought, 80% of you think that that is where HMRC is going to concentrate on. I agree, because of the public profile of this. And I think, therefore, on that basis, I think it's an area where if I was looking at a heat map of places that I would concentrate on, that would almost be my first place to see what were the COVID payments, what period did they take place in, what were the rules when that particular payment was done, and how much was claimed and what has been reported. In terms of the other question, I noticed quite a lot of concern about VAT. It's hard to believe that when it was introduced, it was supposed to be a simple tax. It is nothing but, it certainly is not a simple tax. The important elements within VAT, obviously, if you are exporting to keep up with the changes, particularly in exporting and importing from the European Union, and the changes in the regulations, particularly whether you now need to register because you have significant activities in other countries, whether you need to register in those other countries to do with VAT, as the UK is now seen as a third country on that basis. The other element to be concerned about in terms of VAT is, of course, the accounting for the VAT. For instance, on imports, do you pay for the VAT up front and then reclaim the input VAT on your first return? If you're doing a lot of that in order to deal with the cash flow, do you do a monthly VAT return rather than a quarterly one? All of those sorts of issues you could deal with in a day of dealing with VAT compliance. But there, what I would say is that, again, it's important to understand the systems that you have and to ensure that you accurately can deal with the imports and exports and the VAT forms, given that the UK is now seen as a third country with a separate VAT system. So, for example, in terms of checking the validity for VAT numbers, there is now a separate UK system to a European one. And then finally, on the question of taxes, I think the Chancellor's has announced almost all the bad news on taxes he is going to announce. I'm with those who think he'll keep it the same or maybe decrease it, but we'll see. Time will tell. Someone has asked, we've had to adjust the tax returns for several clients due to them not reporting to us the full amount of loans they've received. Has anyone else had this problem? If you have, you can put something in the chat box. Are these the bounce back loans that they've received? Clearly that is another area where HMRC is going to be looking at quite carefully. The loan itself, unless I'm mistaken, the loan itself is not a taxable receipt, it's not a grant, but you still need to, it still needs to be reported. Hopefully everyone can hear me. And if you have any other questions, you want to put them in the chat box or in the Q&A. So let's go on to best inquiry practices. Obviously, in terms of starting any work, if there are inquiries, you need to check the notice is validly issued. Notice must be in writing, must be given to the taxpayer, must state under which section of the Taxes Management Act is being issued, received within the time limit, and must be within the scope. Very important. One of the areas that becomes a considerable issue, in my opinion, on this. I'm assuming everyone can hear me now. I got a question about whether people can hear me. If you can't hear me, put something in the chat box, but I'm assuming everyone can hear me loud and clear. And must be within scope of what, and it's very important because if you answer as an agent a notice that is invalidly given, you could be subject to legal recourse from your clients. So it's very important that any notice is checked, because quite often HMRC will give a notice that is not valid. And it's something that you need to, answering an invalid notice really causes agents potentially a lot of problems with their clients. What are the types of inquiries that you can get? Well, there are three main types of inquiries. One of them is checking figures or minor errors. The second is checking reliefs, claims, or tax treatments. So particularly with furloughing payments and SEIS. And the third, a more serious one, would be checking undisclosed or potentially false information. I'll come back on that question. I think that, so those are the three areas that need to be looked at carefully. Checking figures and minor errors, as I say, shouldn't lead to a great deal of further work, particularly if you deal with them promptly. The same with reliefs, claims and tax treatments if they are minor elements, but obviously a minor element could be indicative of a more major problem. And then more serious, checking undisclosed, potentially false information, that is a real issue. In terms of resolving those sorts of inquiries, you want to consult with investigations and PS colleagues, colleagues who deal with this area. Consider talking to HMRC to understand their concerns. Keep your clients updated and possibly requiring full certificates of full disclosure. The important element is that you want to try and avoid a certificate of full disclosure if you can. Why would you want to avoid that? Because if a client has had to give a certificate of full disclosure, if HMRCs finds out that there is something subsequently wrong, then the client is likely to face much more serious consequences. Other reasons for avoiding certificates of full disclosure is there you're often disclosing assets rather than just income, and therefore disclosing a great deal more about the client. So dealing with people, when you get inquiries, if you are not a one-person business, do discuss them with other members of your team who deal with private client services or those sorts of areas, or indeed, if they deal with companies, how is the best way of dealing with them, making sure that you deal with them in the best way for the client, taking into looking at how HMRC are proceeding in other relevant cases. If I look at if HMRC find errors, then HMRC need to understand the nature of the error on the tax return. Why did it happen? Could it have been avoided? What actions did the taxpayer take to check the return? And was it a one-off mistake? I think that when you take coronavirus, for example, a miscalculation, there are likely to be a lot of miscalculations. However, and I think that HMRC may well be more lenient in terms of miscalculations where errors have been made than either getting employees to work whilst claiming furloughing payments, particularly with the early furloughing payments, or secondly, the other potential issue there, which I think is even more serious, is claiming furloughing payments and not paying them on to the employees. If that is the case, I think it's very difficult to show that this is a sort of innocent error. There does appear to be malice, certainly from HMRC's point of view, they will be questioning the motives of the taxpayer. If I look at the penalty regime, obviously the answers in terms of what the answers to the questions there on this slide will determine the next stage of any inquiry process. As I said, the type of error that you have will determine the penalty. If it's a simple mistake, there should be no penalty. If it is careless, then it depends on whether the disclosure is an unprompted one or a prompted one. i.e. has HMRC come to you and said, I think there's something wrong with your furlough payments, or there's something wrong with your benefits, or we don't think that you've reported all the pay through pay as you earn, or we believe that you've understated your UK profits and by transferring profits abroad. If it is a prompted disclosure, i.e. you then make a disclosure after HMRC come to you, then you'll have a situation where the penalty will go up. If it's a deliberate understatement, as you can see, the maximum penalty goes up to 70%, and deliberate understatement and concealed goes up to potentially 100%. And notice where there's a deliberate understatement, there is a minimum level of penalty. This goes up potentially if there's an offshore matter. If you are concealing income which is offshore or relates to an offshore matter, then that penalty can increase further. There are mitigation approaches. So potentially, if it is a one-off, you could look for a suspension of penalties as well. With a failure to comply, the initial failure to comply with an information notice, the initial penalty is £300, and thereafter a 60-day, £60 per day. And if you provide inaccurate information when complying, if it's careless or deliberate, the maximum penalty is £3,000. Now, you might think to yourself, well, isn't it better just not to have the information? But if you don't have the information to hand that you should do within the 6-year period, that would be seen as at least careless, possibly deliberate, and we're looking at a £3,000 penalty on that basis. Before I move on to the conclusion on that point, how can HMRC check? So I got a question from Syed. How can HMRC check that a business claimed furlough but did not pass it on to the employees? Very simple. They ask the employees, did you receive this money? Remember, it is a taxable payment on the employee. So if the employee should have had it through the payroll, tax would have been deducted. And of course, it's a taxable payment. And there is no there's nothing to stop HMRC asking employees, did you receive these payments? I think that would be something that you will see HMRC asking. If one person phones up the hotline in a company, I suspect they'll ask lots of others. In terms of Keith's point about bounce back loans, so someone else on this course indicated that bounce back loans need to be reported. I haven't had to deal with a client on that basis yet. I've seen obviously grants, but that is what someone else on this course has said, that they obviously I have not had to do a bounce back loan myself. Can they ask for employees' bank statements? Well, the question would be, if the employees have not declared the furlough payments as taxable income, then that would be HMRC could ask for the bank statements to check that point. So, for example, if I phoned up HMRC and said, I've not received this furloughing payment, why am I being taxed on it? Clearly, HMRC could then ask for the bank statements. I hope that answers the questions. So let's look at the conclusion on this particular section. Do's and don'ts. Well, do consult with others and share experiences. Check notices have been validly issued. Consider housekeeping, risk management, and confidentiality issues. And I think really importantly, proactively think ahead, try to understand where HMRC are coming from, and keep your client updated if there's an investigation going on. Don't leave them in the dark. Even if HMRC are proceeding slowly, at least tell the client that HMRC are proceeding slowly. Don't be afraid to challenge HMRC's requests and views. Provide information not relevant to the tax return. Really important, the information you provide should be relevant to the person's tax affairs. If you provide information that is not relevant to the tax affairs to HMRC, you will end up potentially with a problem with your client. And don't lose sight of the potential penalty position at the end. The more that there is what I call reasonable and correct cooperation, the smaller the penalty should be. So moving on from that, let's look at some current developments. So HMRC's priority in compliance, they look at dealing anti-avoidance. Overseas non-compliance is a big area. HMRC believes that a large part of the tax gap is due to companies and individuals not declaring profits or income from overseas. Accelerating their cash collection, looking at sort of what we call a follower notice accelerated payment regime, and increased penalties for concealment of foreign income or assets. Elements that HMRC can do is if they're doing just a review on a part of your tax affairs, they can issue partial closure notices on a particular issue. So let's say I was a company and they wanted to look at one issue, I don't know, treatment of termination payments, were they treated correctly? They could apply for potentially a closure notice to deal just with that. And taxpayers can also appeal to a tribunal for that. That applies to both existing and new inquiries. And so they can, say, shut down a part of an inquiry. Let's say they've dealt with the termination payments, they closed that, but they haven't dealt with expenses and benefits. They could proceed with that on a separate inquiry. There is a new regime, which is called failure to correct, particularly to deal with offshore elements. What we've got here is significant potential sanctions. Penalty of 200% can be lowered, but no longer, it can be no lower than 100%. And what it is that there used to be an RTC, a requirement to correct an error in your return. If you've not done that, an HMRC open an investigation, they can then accuse taxpayers of a failure to correct, and that can be up to 200% penalties. In addition, for serious cases where there is a serious failure of tax, over £25,000 of tax in a year, they can also increase it with an asset-based penalty. That is a 10% asset-based penalty. What that means is, let's take an example. Let's say I had, I don't know, a place in Ibiza that was worth, I don't know, a couple of £1 million, and I let it out. And I let it out for, say, a couple of £100,000 worth of rent. And the amount of tax that was due on that rent was, say, £50,000 in a year. If I don't declare that property in Ibiza worth £2 million, not only could I end up with a penalty of, say, 200% on that property, on the tax that I've not paid. So effectively, another £100,000 penalty. I've failed to pay tax of 50,000, I pay a penalty of 200%, i.e. £100,000 of tax. But on top of that, they could take a 10% asset-based penalty, which then says, well, that property in Ibiza is worth £2 million, 10% tax, 10% penalty charge. That will give me a penalty charge of another £200,000 on top. So not just a tax penalty based on the tax that I've evaded, but also on the value of the asset from which the income is derived, on which I failed to pay the tax. And as you can see, that could be a substantial amount of money. So for those individuals who have, say, valuable properties overseas, the 10% charge on the property as a penalty could be very substantial indeed. Let's look at some of HMRC's increasing powers and capabilities. As I said, one of the things that I talked about before was the extension to assessment time limit. So the time limit to assess non-deliberate offshore non-compliance has been extended to 12 years. So if you have an element of income which relates to offshore non-UK income, either as a company or a business or as an individual, we're talking about 12 years potentially HMRC has to inquire. That replaced the current limits of 4 years for reasonable care and 6 years for offshore matters. For onshore matters, those 4 and 6 year limits still apply, which means, again, when we're looking at compliance, we're looking at what is the relevant record keeping. And you come up with this sort of the requirement to keep records comes up against GDPR, where under the GDPR rules, you are not supposed to keep information for any longer than is required. So it is important to look at your requirement to keep data secret and confidential, but also potentially available in terms of a tax inquiry for up to 12 years regarding offshore arrangements. So again, in terms of your GDPR reviews of what data you should be keeping and for how long, it's important that you look at what data you might need to keep for longer than the requisite 6 years. If I look at why an inspector might call, normally now not physically, but via letters or emails or telephone calls, the sources of information that HMRC can gather are very substantial. There's plenty of information on social media, whether it is Twitter, Facebook, people's social pages, which HMRC has access to just like anybody else. Doesn't need a Schedule 36 inquiry to get information about what you're doing if you're going to put it online yourself. You can get information from third parties, banks, building societies, financial institutions, information from estate agents regarding the purchase and sale of properties, information from foreign tax authorities like the Internal Revenue Service, and of course, information from disgruntled employees, hence the Dilbert cartoon. And I suspect that disgruntled employees will be a major source of information in HMRC's furlough inquiries. Other sources, of course, neighbours, always useful to get on with neighbours, because quite often they will shop people if you upset them. Of course, divorces are, as in the second picture, a very good way of spouses giving information to HMRC that they would never otherwise find out. Local newspapers, also, something happens, a fire at a business that HMRC hasn't known a great deal about, or indeed things like obituaries. So there was one client of mine who died, and originally the family were going to put in a note in the death notice that he'd built up a big property empire. They thought twice of it. That wasn't my advice, but they thought twice of putting that in the death notice, as they thought that it might encourage HMRC to take a greater interest in what he had done during his lifetime. And then, of course, all the revenue agencies can now talk to each other. So, for example, Border Force, if you're making a claim that you are not resident in the UK, HMRC can get information from the Border Force about your entry and exits from the UK. The same with the UK visas and immigration. And of course, the National Crime Agency works with HMRC, particularly in terms of criminal activities and investigating them for tax as well as fraud. How do people put themselves in harm's way? Well, inconsistent tax returns. There's nothing wrong with having an offshore bank account, but you do need to declare any interest income. And of course, as interest rates start to go up, people might start getting more interest income from their accounts. You operate in what is considered a high-risk industry, which routinely takes cash payments. And of course, HMRC has their little list of industries that they believe are very susceptible to tax evasion, such as hospitality, such as cash businesses, such as construction. Or HMRC receives a tip-off. We'll come back to that. What are the tools that HMRC has in its box? The senior staff that it is recruiting. So almost every year, the government increases the amount to be spent on investigations, and the last budget was no exception. The government believes it puts a certain amount in and it will get out 8 times that amount in additional taxes. Most of this is not going to help people with their form filling. HMRC shut down their sort of online, their high street shops and offices that you could go into some time ago. It's mainly going into staff, investigatory staff. HMRC has around 60,000 staff at present, and an increasing proportion of those staff are being used for inquiries. It has the Connect computer system. I'll talk about that in a little bit more detail a little bit later on. One of the most powerful revenue collection systems in the world. Automatic exchange of information provisions with foreign jurisdictions and new criminal and civil penalties. So in the toolbox are things such as automatic exchange of information, common reporting standards, country by country reporting, and what I call treaty rights. What are we looking at there in terms of treaty rights? So under Articles 26 and 27, in terms of treaty rights, what you're looking at there is potentially the rights of individuals to be chased by HMRC across international boundaries. So, for example, I had a client who was subject to a German tax audit, and he owed money, allegedly, to the German tax authorities. And the German tax authorities asked, and it wasn't a huge amount of money. I mean, it was less than 5 figures. The German tax authorities asked HMRC to collect that money on their behalf. They are also able to exchange information and indeed do investigations on behalf of French other tax authorities. So, for example, HMRC raided, I think, Chelsea, Newcastle, and one other club a few years ago at the behest of the French tax authorities, not because they were looking particularly at the tax affairs of those English football clubs, but because they had a French a football agent who was resident in France, and the French tax authorities wanted some information on his dealings with English football clubs. There's also country by country reporting being introduced for large companies who need to report their activities by country, which ends up with significant transfer pricing, identifying transfer pricing issues. If you've got a large number of staff in one country, but not much revenue, HMRC and other tax authorities will easily spot the inconsistencies. Just a reminder of what they can do with this information. As I say, HMRC can request reasonable information, demand documents from both taxpayer and third parties by serving relevant information notices, and make assessments as estimated in the absence of relevant information from the taxpayer. So not having information is almost never a very good idea. And of course, if it goes really wrong, then the heavy mob can raid commercial and domestic premises to seize documents, put a lien on goods, collect sums from bank accounts under the direct recovery of debts. So if you fail to cooperate, potentially with certain safeguards, HMRC can now circumvent the court and collect the money directly from your bank account. Withdraw CIS gross payment status. So the JP Witter case was a interesting one where a gross payment status was certificate was withdrawn, meaning that the company had to make tax withholdings. That was considered as particularly bad for the business, but it went as far as the Supreme Court to say, actually, HMRC has the power to do so and needs to do so if the gross payment status is given as a form of conditionality, something I talked about before. If it is given as a form of conditionality, it is a privilege to get the gross payment status. If you don't comply with tax law, then that gross payment status would be withdrawn. They can, of course, levy penalties and interest and initiate criminal prosecutions. This is from HMRC's own document called No Safe Havens. And it's shown how the world has changed in the last 10 years. In the last 10 years, they've developed a global exchange of financial information, comprehensive penalties for UK tax evaders and those who enable tax evasion. So you don't actually have to be evading tax. If you enable it in any way by providing facilities, you can end up with a penalty. Corporate, so companies criminally liable for failing to prevent the facilitation of tax evasion. And that then again takes it further. This isn't companies actively evading taxes. This is omitting, failing to prevent. So it's a negative action. If you do nothing to prevent the facilitation of tax evasion, for example, if you do nothing to check on your cash payments and so on abroad particularly, but in the UK as well, if you do not have the systems in place to check what your employees are doing when they are on company business, then you will end up potentially with a corporate penalty. And this comes back to the point that what HMRC will look at will be your systems. How do you check matters? What is the way you audit transactions? How do you check that employees, when they are working on your company business, are acting in a proper way? And this isn't just on tax. This is more widely in terms of, for example, to stop bribery and other illegal practices abroad. And what HMRC is looking at more and more is not just what is happening, but whether you're taking the right steps to stop something illegal happening. If you turn a blind eye or don't do anything to stop these matters happening, then the company can be responsible. By doing nothing, a company can become criminally liable. And internationally agreed rules to tackle multinational profit shifting, a number of changes in those areas. Let's look at the world. All the world in green are countries where the UK has some form of protocol allowing for exchange of information. The countries in red are where there is no such agreement. So in order to be ensured that you do not, your funds are beyond the knowledge of HMRC, you would need to put it in places like North Korea or potentially Afghanistan, Iran, Syria, Iraq. And so therefore there are other considerations about why you wouldn't put your money there. But in 90% of the world, the expectation is that the UK will find out about your activities or your company's activities in those other countries. As a result of that, 5.67 million records were received on UK taxpayers' offshore financial accounts in 2018. And despite coronavirus, those records numbers have increased. And then what do they do with those records? Well, they go to the system known as Focus Connect, which is HMRC's analytical tool. Connect cross-references more than 22 billion lines of data, including customer self-assessment returns, property and financial data. And Connect identifies more than 500,000 cases onshore and offshore for HMRC to inquire into each year. As I say, in terms of common reporting standards, 2018, they received 5.67 million accounts. So, you know, sort of 1.63 million records related to accounts held by 1.3 million individuals. There are obviously some customers, as HMRC calls them, have used the worldwide disclosure facilities before they're detected by HMRC using the common reporting standard data. Others have done so after receiving a letter. However, HMRC, if the disclosure is prompted by an HMRC letter, they will undoubtedly look at potential penalties. And as I say, in terms of treaties, this is here so that you can look at it later on, have an extensive network of 150 jurisdictions around the world and allows for tax information to be requested. So the point is the world is a shrinking place, and it's not a question of whether HMRC will get the information on offshore investments and activities, it's when they'll get that information. And in terms of a global public register of interests, that is being formulated and increased. So that again looks at assets, and it's an area where tax authorities are looking to cooperate more. This global public register of interests, which will make it more difficult for individuals to hide assets for what HMRC believes are illegitimate purposes. So what do they do with that information? Well, quite often the inspectors will get together. That could be for VAT, because obviously that will involve turnover as well, corporate taxes involving companies, IHT and capital taxes and self-assessment, and they will look at the information and then determine whether to launch an inquiry. It is very rare that random inquiries are launched. So the 9A inquiries are generally based on information which HMRC have received. A nudge letter might be based on a piece of information that's come into their domain regarding some third-party information regarding a bank account. But generally speaking, most HMRC does not have the capacity or the desire to launch a lot of random inquiries. So generally it's based on something that starts, we have reason to believe that something is wrong. I talked about the deadlines before. Just a reminder that effectively, if you've got fraud, you're going up to 20 years and 12 years for offshore. How do they investigate? Well, they can ask for third-party information notices under Schedule 36, or they'll get data gathering notices, bulk information from third parties, from bank accounts, that information. So they might ask and receive information on all the bank accounts held by a bank in a particular jurisdiction, which relate to UK residents. In terms of property, what they're looking at there is a person having use of land, and the following data holders are identified: an occupier of land, a lessee, and a person having use of it. And they can go either to the landlord or to the tenant in terms of that information. They can also go to a person whose agent manages land or is in receipt of rent or other payments arising from land. This is an area where HMRC believes that there is significant amounts of evasion. And this is an area where HMRC will look for that information on a regular basis. The area that becomes a real boon for HMRC is merchant acquirers, those processing debit and credit card transactions for merchants and retailers. So, for example, every time you use your card, even on a wireless transaction or contactless transaction, HMRC can get that record. And the same is true for business intermediaries, booking and reservation companies, such as those taking payments for holiday accommodation, restaurants, supplying takeaway food, and outlets reselling tickets for entertainment events. What does that do? Well, it gives HMRC a very strong picture of where you are and what you're doing. And that has gone further to electronic payment services providers, those providing digital wallets, which allow for payments by smartphone. As I indicated, that information is then passed around government departments, not just HMRC's Capital Taxes Office, or indeed its other inquiries. It could go to the Department of Work and Pensions. There's information from Companies House, the driver and vehicle licensing agency. So you've got a lot of money that's undisclosed, and suddenly you've picked up a nice flashy new car. DVLA may pass those details on. The same with, you've decided to splash out onto buy-to-let properties. The land registry is likely to know as well. So you can see that information is no longer siloed. It runs around and flows between government departments. A good example, as I say, of how does HMRC know? Have a look at the R. Ward versus HMRC case. Taxpayer claimed to be non-resident in the UK for 2009-10 and 2010-11. HMRC got information from UK Border Agency for 2 years, proved he'd spent 183 days each year in the UK and therefore resident. Someone has asked, Sides has asked, what are the motives from HMRC's counter avoidance department to raise inquiries under 9A for a client? How do they pick a client under this? Well, generally speaking, they're going to be looking at, for example, are they participating in a registered tax avoidance scheme? That would be one. Secondly, have they got information from an agent about a scheme? So maybe HMRC has gone and said how many people have done this scheme, film scheme or so on, and they'll have got information. Or thirdly, they will have got information from other third parties. So it could be self-disclosure, because some avoidance schemes need to be disclosed under the DOTAS rules. It could be from third parties, or it could be that they ask a question regarding tax avoidance schemes that you have entered into, or something just doesn't add up on the return. So there's a variety of different ways. Hope that answers the question. So, so a number of variety of sources. Obviously, one of the motives is you're going to pick taxpayers where there's a substantial amount at stake, you know, same effort, more money that you might collect, just like in any other walk of life. In terms of the third-party relationships, clearly, HMRC is going to look at the difference between what you pay to what you are paid by customers and what you receive from suppliers, and that is going to give you your potential profit margins. And that's the sort of element that HMRC will look at. In a cash business, one of the ways of catching out people who underbill is you look at the level of supplies. You know, a fish and chip shop may well sort of underdeclare the amount of fish and chips it sells, but one of the ways that HMRC will look at it, and is quite a reliable way, is to look at, well, how many potatoes are they buying, given the wastage and so on, what level of potatoes would that lead to chips, would it lead to be sold, and therefore go back to what are the supplies, what is the reasonable assumption about how much is then sold. Or if you've got a mini cab driver, they may look at the petrol that the mini cab driver is buying and work out the mileage based on that. Okay. I have someone said that my client is a sole trader dentist and has received a letter from counter avoidance section of HMRC and there's no tax avoidance scheme. He's 85 years old and very sick. In that circumstance, my recommendation would be that you would phone up HMRC and see if you can get some sense from them as to their motivation. They may well give it. If you explain the circumstances, it could be just an error or mistake from them. And I think that, you know, if you've got something that looks obviously wrong, where you've got, you know, a dentist who's 85, very sick, and probably has not been involved in counter avoidance, you might go and ask them, well, what prompted you to come up with this? Because sometimes if you explain the circumstances, they may explain or back away. I'm just going to do a couple more slides before our final break. This was an interesting example here. HMRC versus General Electric. They had a 2005 agreement. In 2011, HMRC starts discovering new information. And in 2020, the High Court action disapplied the 2005 agreement, alleging that there'd been fraud. And why is this important? Well, because the issue there is that if you make agreements that are based on false information, HMRC can go back and overturn those agreements. And I always think that that is an important element that you look at. And then what is the difference between an informal and a formal agreement? So the Court of Appeal confirmed the Chancery Division in dismissing an application for judicial review, agreed that HMRC has widespread powers to investigate taxpayers either formally or informally. But with an informal investigation, the taxpayer could at any time refuse to cooperate and force HMRC to issue a Schedule 36 information notices. So you do need to decide at what point do you say to HMRC, no, this is as far as I'll go with an informal investigation. If you want further information, you need to put it on a formal basis. And then the final one, which I think shows, the final two cases before a quick coffee break. I love this one because it shows the information that can be got. Mr. De Silva claimed to be not ordinary resident. And this was important because he was looking for foreign service relief on his termination payment. And it failed on the facts. And I don't need to go through the facts of the case, not particularly relevant, but it shows how easy it is to get a picture of a taxpayer's lifestyle. In the facts, the first tier tax tribunal states the evidence was not consistent with Mr. De Silva's claim that he spent 70% of his time outside the UK. He had an annual rail season ticket for travel in the UK, regular payments on his credit card and out of his bank account to UK golf clubs, other clubs, bars and restaurants, a London gym, and frequent cash withdrawals from his London ATMs. And HMRC could find out all that information, and that would consistently prove that he was clearly in the UK for enough time to be resident in the UK. Another example involving cards, this was a case called about the PECs. They claimed that they were not residents, had moved to Monaco and changed their lifestyle, and HMRC were able to plot the PECs, Mr. and Mrs. Peck's lifestyle from their credit cards. What was the HMRC interest? They said that the fact that they'd spent less than 90 days in the UK in the years in question was insufficient to show they'd created a distinct break. And it shows the efforts that HMRC went to. The credit cards there were used to prove where they went, who they met, and what they did. And what they showed was that their lifestyle in Sussex at the time had not changed from when they agreed they were residents in the UK to the period when they became not residents in the UK. And the credit card receipts showed where they'd been, who they'd met, what they'd bought, and where they'd stayed. And that was sufficient on that basis. Okay, let's take a 5-minute break and we'll be back at 11:10. If anyone has any other questions, please feel free. I'm also happy to answer them at the end. One other element in tax and insolvency. So from the 1st of December 2020, HMRC moved up the creditor hierarchy for taxes paid by others. So in terms of where a company goes bust, and the difference is where it is effectively handling tax paid by others. So let's say I have a company, I charge VAT, people pay me the VAT. If that is not paid on to HMRC, that has a priority over other creditors. The same is true of pay as you earn. In terms of pay as you earn, I'm deducting money from what I'm paying to my employees. If that is not paid to HMRC, it moves up the hierarchy. On employee national insurance contributions, again, it's deducted from employees. If that is not paid onto HMRC, again, they're up the hierarchy. Student loan deductions and CIS deductions. They are deductions that I take as a company from somebody else. If they're not paid onto HMRC, that becomes a problem. So that's the sort of element that I think you need to think about when it comes to suddenly HMRC being a preferred creditor in those areas where the company is basically acting as tax agent for other people. In terms of the joint and several liabilities, the other element to be aware of is joint and several liabilities of company directors allows HMRC to recover tax and other liabilities generated through tax avoidance or evasion, or through repeated insolvencies where there are outstanding tax liabilities. So where you've got directors who've started a company, it's gone into liquidation, they've started a new one, it's gone into liquidation. Repeat offences will mean that the directors will be potentially personally liable for tax debts. And allows HMRC to issue notices to directors and others connected to a company, making them jointly and severally liable for any amounts that become due to HMRC as a result of avoidance, evasion, facilitation of avoidance, or repeated insolvencies. And this has been extended to coronavirus payments, CJRS, which have been done again wrongly. So it's an area where the protection that the company used, the corporate veil used to give, has been very much eroded. And it's now a situation where what we're looking at here is company directors need to be very careful about what their companies are doing in terms of tax liabilities, because those liabilities could fall back on themselves. Question in chat just about is ACCA accredited. I'll leave because it's in the slides that you can have the additional penalties in respect of offshore transfers. It's there for your information, but just shows that in terms of offshore tax avoidance, the position becomes more difficult. I talked about leveraging of licenses before. So where a business is non-compliant, HMRC will inform other parts of the public sector, and all potential licenses could be refused in the future. So it's an area where if a business is requiring the cooperation of the public sector, or indeed where the public sector is a customer, that could cause problems in the future. In terms of penalties, another element where HMRC has tightened up is that if they do an inquiry and the first offence is not deliberate in an area, and HMRC then informs the taxpayer of the error, and then HMRC comes back and finds there repeat offences in that same area, that will be seen as deliberate, and therefore the penalty regime will go up. So gradual tightening up in this area. Let's look at the most serious elements. So if I look at the most serious elements, they would be if HMRC suspects fraud, sends letter to client. Now that could be an individual, or as in the GE case, it could be a company. The client has to decide, has 60 days as to decide whether to cooperate. And that would require cooperation and full disclosure, or they can fight that. So the idea would be is COP9 is for serious cases where the likelihood is that HMRC will accept a civil settlement rather than a criminal, go for criminal prosecutions. But you have to then accept their disclosure facilities. So COP9 stands not for some form of environmental conference. This is Code of Practice 9, which is how this was originally set out. The letters that are sent normally start with, we have information that gives us reason to suspect you have committed tax fraud. We will not usually tell you what our suspicions are. So this is at the heavy end of what you were doing. The choice that is given is, it is for you to decide whether to make a disclosure to us. We will keep an open mind to the possibility that there may be an innocent explanation. Thanks very much for the suspected fraud. That is my bit in red. And we will treat you fairly and politely and in accordance with the law. You would have thought that that goes without saying, but it doesn't always, that isn't always the case, to be honest. But, this is how HMRC set out their guidelines on that basis. So I think important that you understand that is the serious end of this basis. Let's take it further than that. What happens if you decide to cooperate? Well, you've got to go further. You know, merely stating that your deliberate conduct has brought about a loss of tax will not be acceptable. You've got to incriminate not only yourself, but others. So a bit like in the lives of others, you've got to say how you've committed this particular fraud, what you did, how you did it, the involvement of other people and entities, and how you benefited from the deliberate conduct. And I think that is something that you need to think about quite carefully. If you get this sort of inquiry, this is the point at which you decide whether you should be dealing with it or by yourselves, or whether you need to get a second opinion or specialist advice. This is not an area that I would deal with myself. Once I deal with investigations, but if it gets that serious, I would want a second opinion, solicitors potentially, if I think it's going to go for a criminal prosecution, or another firm of accountants who specialize in that area. I think the picture of the next person who famously said, Clint Eastwood, a man should know his limitations. This is where I know where my limitations are. I would not deal with an investigation of that seriousness on my own. And the HMRC choice really with the COP9 is, a bit like in Clint Eastwood, you've got to ask yourself one question: do I feel lucky? And it is one of those sort of occasions where they're saying to you, you can fight us and fight us all the way. Do you feel lucky? Do you think you'll get away with it? And most companies at that point go for some form of accountant's report and self-disclosure. If you don't cooperate with HMRC, they can start their own investigation, which may ultimately be a criminal investigation. So, the possibility of jail time starts to become more relevant, and is something where HMRC is under pressure from Parliament to lock up more tax evaders to encourage others to be more compliant. Get information about your financial and business affairs from third parties and take formal action, including raising assessments for the tax and interest we consider is due. Obviously, if you don't cooperate, they will charge significantly higher penalties, start legal proceedings to secure some or all of your assets, and potentially require financial security against certain unpaid taxes and duties, so seizing property and so on. So I think that those are the sort of areas where I can see, this is an area that they will use and deal with those powers if they don't think that they get significant cooperation. As I say, even if they don't go down a COP9 route, they could look at the failure to correct on the potential loss of revenue. And as I say, potentially with the offshore asset penalties, the premium of 1.5% means a potential 3% penalty, plus the asset-based penalties, plus naming and shaming, i.e. publishing their details. So what do people need to think about? Well, as you talked about in the polls, what is the situation and how will COVID payments affect all of this? And I think COVID payments, how would I deal with that? I think it's the first thing that's going to be looked at because there is so much attention to it. And the way I would deal with it is a spreadsheet. I would start with a spreadsheet with everyone who got the payments, how much they got, what their job was, were they notified of the change of arrangements? Can you confirm they did no work, at least for the earlier parts of the COVID period where no work was allowed? And when did they come off furlough and what happened to them then? And you could then separate it into the different furlough regimes with the 80% payments, the 70% and the 60%, looking at the calculations and then finalizing that spreadsheet, confirming that those payments were made. And I think that most businesses that are concerned about that should be setting up a spreadsheet with those details on there, making sure that the points that I made at the beginning of the presentation about the things that could be potentially wrong have been addressed, and that you've got an assurance that you've done the right elements in terms of not claiming furlough when people were working, not paying that furlough on, calculating it right with the right amount of caps, making sure that people had salary payments before they went on furlough. Those are the elements that you need to think about. Oh, some questions have come in. Right. I cannot access the notes. Questions. No questions for me, just about the notes and the slides, which I'm sure K3 will deal with. So I'm hoping that that would be the start, because if, for example, HMRC finds that people and businesses have been claiming furlough payments while still working or not passing them on to the employees, you can understand how that will affect their attitude to their company. Let me look at a few other developments. So a number of companies, a number of IFAs, I think I have a few on this course, have looked at family investment companies as an alternative to trusts or as an adjunct to trusts. They became chargeable when gifts into trust, particularly in interest in possession trust, became chargeable in 2006. So, example, wealthy entrepreneurs subscribes for 10 million of share capital into a company, 10 million 1A shares, which have full capital and dividend rights, but no voting rights, and 100 1B shares, which have full voting rights, but no rights to any assets or income, gives A shares to his 20-year-old son while retaining shares. After 7 years, 10 million of value would fall out of his estate, but father still has power via B shares to restrict his son accessing that value. At a superficial level, the company's been used in a similar way to a trust. Now, the family investment companies have become much more popular, and there was a unit looking at them, but they concluded that they were working in the way which was intended. They weren't being used for aggressive tax planning, and therefore they decided that they would take no further action. The other point is, of course, family investment companies are taxed at the corporate tax rate. That rate will go up to 25% next April, thus giving HMRC a bit more tax on family investment companies and making them somewhat less concerned about them. Okay, but that's an example of if you're doing this, you would need that compliance to be right. The next element is a good example of compliance in terms of the tax status of a partnership paying amounts to a partner. So in this case, the individual was an international tax specialist who was engaged by Haynes Watts as a fixed income member of the LLP with restricted voting rights, filed returns showing profits as a partner, but then started showing as employment income. HMRC sought class 4 on the basis of a partner. It's not really a tax question, but focused on criteria which determined whether he was a partner. Concluded he was a partner on that basis. And again, status is extremely important in this area. When you're looking at, do I pay class 4 NIC? Do I pay class 1 NIC? What is the deductibility of my expenses? This is an example in compliance of something different. And what I think we're seeing more of is the claims for research and development costs, and this has quite a large compliance burden. For smaller companies, research and development is extremely valuable. So if I spend £100,000 on R&D, I get a deduction of 230% of that, i.e. £230,000. But increasingly HMRC are querying the R&D claims that have been made. And here, with R&D claims, you need a lot of information to back up those claims. You don't have to send that information in at present, but the situation is that if I want to claim R&D, I need to think very carefully on the basis that I do it. Most R&D obviously is developed by human beings, and therefore you need their salary details. You need their other employment cost details. You need the cost of the materials that they're working on. You need, if they're working on R&D exercises and non-R&D exercises, you effectively need timesheets to show what proportion of the time they were working on R&D activities, and therefore how much could be claimed. In this basis, if you make the claim and HMRC challenge it, you do need all those details of the project that it was on, the uncertainty that was trying to be solved by this project. Does it qualify under the basic principles of extending knowledge in a particular area? So there you need something which the company needs to minute meetings and progress of a project to see whether it qualifies under the underlying principles of expanding knowledge beyond what a reasonable professional in that area would know. So you need to know what the project, the R&D project, is planning to do, how it's going to achieve its objective, who's involved in that, how the project has developed, how much time individuals are spending on that project, what their costs are, what the materials are that they're using, and if there's any subcontracted labor, what are the costs in that subcontracted labor and how much do they relate to the R&D. So HMRC wants this information there, so that if it is challenged, and more R&D claims are being challenged, you've got that, and you can support the basis of an R&D claim. The R&D tax reliefs are very generous, but what you're seeing in the courts is more and more challenges on that basis. So it's another area of compliance that people need to think about. This is a status case. I talked about early on about employment versus self-employment. So you've had a number of famous presenters who have their status as self-employed challenged, some successfully, some not. And they started off HMRC with a big success in the Krista Ackroyd case, but did lose some cases as well. And it's sort of around about 50-50. They won the case on Eamon Holmes, saying that his services were relevant services for IR35, for example. So it's an area where HMRC looks at in some detail, and you can understand why, because it's a substantial amount of money. Let's look at this case, George Mantidis, and why it's an important case is that this individual is a locum neurologist for two hospitals. One was the Royal Berkshire Hospital in Reading, and the other one is the Medway Hospital in Kent. And he's doing pretty much the same job. And what the what the tribunal said was that although they were doing the same job, in the Royal Berkshire Hospital, what he had was that there was sufficient mutuality of obligation, i.e. the hospital had to provide him with work and he had to accept the work, that the underlying contract was one of employment. And he also used the hospital's equipment. So that case would indicate, okay, employment. Does that not work for the other elements, the other contracts that he had? And as I say, under this basis, there was the tribunal said, looked at all the factors together, and on a balance of opinion, said that Mr. Mantides was employed by the Royal Berkshire Hospital. But if you compared that with his work as a consultant urologist with the Medway Maritime Hospital, the tribunal said that there were three differences. One difference was under the notional contract with Medway Maritime, had a right to send a substitute if that substitute was approved by the agency. The notional contract with Medway Maritime could be terminated with just 1 day's notice, and the notional contract with Medway Maritime would have contained no obligation on Medway Maritime to provide a standard amount of work. Remember, within IR35, what you're looking at is that this is a contract with a personal service company. And the question is, if you took out the personal service company, would the individual be in an employment relationship with the end user? And the interesting element is, although the individual's doing the same job pretty much at Medway Maritime and at the Royal Berkshire Hospital, because of the conditions of the contract to Royal Berkshire Hospital, it was seen as employment. In the conditions of Medway Maritime, it was seen as self-employment. This indicates that you can't just read across from one activity to another and say, well, if activity A is self-employed, then activity B must also be self-employed. You've got to look at each engagement in turn. What does this mean in terms of compliance? Well, this has now moved very much to the end user, the final user of the services. What happened in 2021 was the responsibility for IR35 in April 2021 moved to the end user. And on that basis, because it moved to the end user, more companies have had to look, banks, those using IT, larger institutions, solicitors, accountants, and so on. What is the status of their contractors? Are they employed or self-employed? Filling out status determination statements, and then ensuring that if they are seen as within IR35, that the appropriate pay and national insurance deductions are made. What this case shows very clearly is that there are no shortcuts on this. You've got to look at each occasion. This went to appeal, and in the appeal, HMRC said that the Medway Maritime was employment, and George Mantides cross-appealed and said the Royal Berkshire Hospital was self-employment, unsurprisingly. But what happened was that the first-tier tax tribunal stayed on the occasion and said that they would wait until the decision on the professional game match officials limited case is made public by the Court of Appeal as to whether to overturn the decisions on there. But the important element is to show very clearly that, as I say, each employment status case needs to be looked at on its own merits. This was a really important case, HMRC versus professional game match officials. PGMO engaged part-time referees under an overarching contract that it covered the entire football season. Individual contracts for each game, whereby referees were only paid if they officiated the match. Referees had control of what went on during the game, subject to FA regulations. At all other times, PGMO had various rules and regulations that needed to be followed. HMRC issued determinations that the referees' payments were employment income. The first tier and upper tier found that the referees to be self-employed, concluding that under the overarching contract outside the individual match engagements, there was no mutuality of obligation. HMRC then went to the third stage of appealing to the Court of Appeal of England and Wales. And they said by looking at whether there was a mutuality of obligation, i.e. a requirement of the professional body to give the referees work and a requirement for the referees to accept their work, both the tribunals had applied the wrong legal tests. They should have applied the mutuality of obligation control test to each individual match engagement under which the referees officiated and were paid. They said that both tribunals erred in law when finding that the ability of each side to pull out before a game negated MOO. However, this has now been referred back to the first tier tax tribunal, and we will need to look at this case once the first tier tax tribunal has given its rulings. Why is this important? Well, it's important because in determining status, mutuality of obligation, i.e. to the extent that the organization needs to give someone work and to the extent that that work needs to be undertaken by the employee, are they really a free agent able to accept or reject work? That has become very important in status cases. And this is becoming a major issue in terms of compliance. What you should be looking at is every 6 months reviewing the consultants that give you that provide services to you to ensure that longer, where consultants sort of end up getting billing the same amount every month for similar services, are they becoming employees? And in terms of compliance, this has become one of the major areas. In terms of auditing this area, what you're going to look at there is checking very carefully to ensure that there is a procedure to check that your consultants are really consultants and not disguised employees. Okay. Any questions other than, can I have the note of the slides, which are available? Ask K3. So I think, after the COVID support payments, self-employment status is going to be extremely important. There's a case here. The next case is interesting for those who advise clients who deal with share schemes. Remember that if shares are provided by reason of an employment, they are generally subject to income tax. Whereas, of course, if they're not provided by reason of employment, any gain is normally subject to capital gains tax. So it is always important to understand whether shares are provided by a person's employment. So, for example, let's say I was a BT worker and I decided, BT doing well, I'm going to buy some shares. So I go to a stockbroker and buy some shares, an online stockbroker. And sure enough, the shares do well. And a month later, I sell them and I've made £1,000 profit because I bought them off my own account, nothing to do with the company I'm working for. They are not by reason of my employment, and the £1,000 I make would be subject to capital gains tax, not income tax. Whereas if BT provides me as an employee an opportunity to acquire shares through a share option scheme, if it is a non-tax advantage scheme and I make a similar £1,000 on it, that would normally be subject to income tax. In this example, this was about an individual. Did he have what were called employment-related securities, i.e. securities which relate to his employment? Remember that from a compliance point of view, every 6th of July following the tax year end, the companies need to put in the relevant share scheme returns by the 6th of July following the end of the tax year. And this is important. This was a case, one person talking about a £385,000 gain. The first tier tax tribunal found that they were not employment related securities. The upper tier tax tribunal found they were employment related securities. This, because it was a Scottish case, went to the Court of Session. And in the Court of Session, this is a case about somebody who received the shares before they received got an official position within the company. As you'll see at the end of the slide, they were seen, those shares were not made available by reason of the individual's employment. Why is this key? Well, as I said, it's up to the company to make declarations of shares which have been granted to employees by reason of employment. They need to be done every year. They're normally, if you have an administrator, the administrator will prepare the necessary forms. And those forms should then flow through to the individual self-assessment tax returns. And it may be, of course, that pay-as-you-earn has already, and national insurance has already been accounted for on a gain on shares. But if it's not, because it's not a readily convertible asset, these forms are very important because they'll form the basis upon which the individual will have to pay the tax when they do their self-assessment tax return. Happy to take questions, but I think as a point of compliance, one of the last things I talked about in the large laundry list at the beginning, share scheme compliance is fundamental. And because of the amount of money, particularly to senior directors, it is something that needs to be recorded on a regular basis, both in terms of the effect to employees in terms of the income tax and national insurance they may have to pay, to the employer in terms of the income tax, the national insurance that might be paid if they're a readily convertible asset, but also in terms of the corporation tax deductions that may be available for the expenditure on shares. Another issue which comes up regularly on that basis, is, whoops, gone too far, is termination payments or other lump sums. So this end of it, can you recommend any resource to know more about share schemes? There is if you want to know a resource on that, so there is edited by a good colleague of mine, David Pett, a 2-volume, I think it's called Thompson's, which is the guide to share schemes. And it's a 2-volume loose leaf pack, which is updated every 6 months, which gives a guide to share schemes. So that would be a good reference there. In terms of compensation allowances, if a company gives money to an employer, doesn't have to be a company, to an individual, will that be taxable? In this case, the individual received 45k in return for giving up his contractual right to an allowance in terms of information technology. The only condition for the payment was the surrender of this allowance that he received. And because the allowance itself was taxable, the individual still argued that the lump sum was an ex gratia lump sum with 30k tax free. But the first tier tax tribunal made the decision that the payment was to compensate for the loss of an allowance that previously formed part of Mr. McAllister's salary. It was taxable as employment income as it was paid solely for a change in the terms and conditions of his employment. A lot of people think if you get a lump sum in return for loss of something, that will be tax-free up to the first 30k. That is not true. You have to look at the source of where the compensation came. So if the compensation is for a taxable allowance, the allowance itself is almost certain to be taxable. Okay, any questions on that? So termination payments, just because you have something that is ex gratia does not mean that it is tax-free. Another, I thought, interesting case here, bonus payments to LLP members. So this was Charles Tyrwhitt. They had a bonus system for its employees. 5 employees received bonuses under the scheme, but at a time when they'd become LLP members. So were they receiving it in their capacity as employees, or were they receiving it as partners? And although by the time they received the payments, they were partners, the court said quite clearly that Class 1 national insurance was due on it because there were no changes to the terms and conditions. This was an employment-related scheme. When the 5 employees became LLP members, the parties did not agree that the 5 individuals would surrender their contractual rights against the LLP to prospective bonus. So there were no change in the terms and conditions. So the first tier tax tribunal said quite clearly this was an employment-related bonus, and although they're no longer employees, they're partners, it should be treated as an employment-related bonus, subject to pay as you earn and national insurance in the normal way. This was then appealed to the upper tier tax tribunal, and they upheld the decision of the first tier tax tribunal. The individuals received the bonus payment in their capacity as former employees. The bonus payments were contingent on the employee's contractual requirements being met, and so should be taxed as employment income, even though the individuals received them after the employment had ceased. And that's another example of tracking why you are making payments and to what they relate to. It's an interesting element which is coming up, and I think will come up more and more. One of the things that COVID has accelerated is the decline of cash. And what you can see with the decline of cash is, of course, more payments being made electronically, being made on a contactless system. And of course, that should mean that more payments are going through the books and less are in cash. So less opportunity for people to suppress payments. But on the dark web, a number of people have bought electronic sales suppression equipment to manipulate electronic sales to reduce or hide the value of their sales, while providing what looks like a compliant audit trail from sale to tax reporting. Now, HMRC are aware of this, and they are giving an amnesty to people, a partial amnesty to people who fess up on this basis. The changes to include this are establishing large penalties for making, supplying, promoting, or using these tools, including any software, hardware, or other thing that is capable of suppressing records, electronic records, where it is reasonable to assume it has a main function of doing so. So if you buy this and use this, there will be large penalties. Taxpayer protections include removal of penalties where the person in connection of such a tool is unaware that it was an ESS tool, and special reduction and appeals. There are specific information powers to enable HMRC to obtain the details of those involved in the supply of ESS software or hardware, and these changes will have an effect very shortly from royal assent to the Finance Bill 2022. Which, if it hasn't happened already, is happening imminently. But you can see how this is an issue for potentially for clients if they have used electronic suppression, sales suppression. They are likely to be hit and hit hard by HMRC if they are caught. A final couple of points. We've got 7 minutes. It's an additional penalty for the UK facilitators of offshore promoters. Some tax avoidance schemes are promoted by non-UK resident promoters using UK intermediaries. And effectively what they're saying on this basis is that there will be penalties if they fail to comply with the regime to disclose these promotions. So remember, if you are approached with an off-the-shelf tax avoidance scheme, it will normally have to be disclosed under the DOTAS arrangements, disclosure of tax avoidance schemes, using a registered number. Some people have tried to circumvent this by using an offshore promoter. But if it is part of a chain with a UK resident facilitator and those promoters do not do what they need to do in terms of registering the scheme, then the UK facilitator will be charged that 100% penalty. A further crackdown in that area. 5 minutes. Wanted to talk very briefly about non-tax advantage share gifts. Remember that if a company gives shares to its employees, particularly if they are what are called readily convertible assets, then pay-as-you-earn and national insurance will be due. What is a readily convertible asset? Well, as it says, as the title implies, what you're looking at is a share that can be easily traded via an employment trust or on a recognized exchange. Very important, you need to think about the pay-as-you-earn consequences of that. If you give shares that are not in a tax advantage scheme, i.e. not SIP or SAYE or CSOP or EMI, then if they are readily convertible, I can go and transfer them into cash or easily put transfer the value into cash, then they could well be readily convertible assets and pay-as-you-earn would be due. The challenge of that is getting the market value on those shares right. The compliance treatment is driven about whether the shares are readily convertible assets. If they are, both income tax and Class 1 national insurance are collected via pay-as-you-earn on the share-related income. And what I've put in the slides are the detailed definitions. If the shares are not readily convertible assets, as I indicated, the employee will pay income tax through the self-assessment system. The payroll mechanics for readily convertible assets are that the employing company must account for payroll taxes under pay-as-you-earn by including the taxable value of the share award, and then that will go through pay-as-you-earn. And the employee must make good the pay-as-you-earn by the 6th of July following the year in which the pay-as-you-earn takes place. So if you gave me some shares now, that would go through pay-as-you-earn. If I don't have sufficient money to pay the tax, it still needs to be paid, reimbursed by me by the 6th of July 2022. Otherwise, there would be a penalty charge. As I indicate, that is 90 days after the end of the tax year in which the notional payment is made. That would be by the 6th of, so if a payment is made in this tax year, needs to be reimbursed. So in other words, if the company pays the tax on my behalf, it needs to be reimbursed to the company by the 6th of July 2022. Some employers have a sell to cover withholding arrangement whereby the employer acquires beneficial ownership of all the shares subject to the award, but immediately sells some of them to raise the cash. Let's take an example. Let's say I got £1,000 worth of shares and I'm a high rate taxpayer and the shares were £1 each. I could instruct the trust to sell 42% of my shares to pay the £420 tax and national insurance, and I would keep the other 580 shares. And that is the normal way of dealing with the compliance aspect on there. In terms of the compliance reporting, as I say, the company, if it doesn't all go through the payroll, the company has to report this by the 6th of July, following the year in which the share award is made. Two final points. One is loans. So employment-related loans, and we've seen less of them because less people are doing season ticket loans, but interest paid by employees should be under an obligation that existed during that year. So in other words, if I have a loan and I want to extinguish the P11D charge, I need to have it on a structured basis. So the official rate of interest, in order to avoid a loan, I need to pay the official rate of interest to my employer. So if I have a loan of £100,000 from my employer, I need to at least pay the official inland revenue rate of interest under an agreement to avoid a benefit in kind charge. I have to ensure it is settled by the 6th of July, following the year in which the loan is available. So any outstanding payments for this tax year, again, need to be made by the 6th of July, 2022. There is a £10,000 exemption that applies per employer or group of employees and does not apply per person. So an employee with two jobs could have two separate 10,000, neither of which will give rise to a taxable benefit. The important element there is you do need to look at the compliance for closed companies, particularly where there are substantial loans given to directors who are owner managers of a business. There could be a requirement for the company to pay 32.5% of the loan to HMRC, which will only be refunded when that payment is, when the loan is repaid. So where you have a closed company, a family-owned company, you have to think about two elements of compliance. One is the benefit to the individual, if they are paying less than the official rate of interest. And the second is the company's obligations to make this notional payment to HMRC. Well, it's a real payment, but based on the loan amount at 32.5%. And that needs to be paid and held by HMRC and is only returned when that loan is repaid. And then my final point at 2 minutes past 12, it's an interesting case, two very similar cases involving suppression of takings in Chinese takeaways. And this is an example of where record keeping is important. HMRC did an unannounced visit, found that takings were higher than average, and so HMRC argued suppressed takings. Owner argued that it was not representative. It's Chinese New Year and then Midsummer Payday. And the FTT agreed that HMRC's assumptions were unreasonable. And the owner was able to show from their records that just taking 2 days and extrapolating the two probably busiest days for the takeaway shop Chinese takeaway were unreasonable, because obviously their takings were likely to be higher on Chinese New Year. Another example was HMRC made one visit with takings being more than average, so assumed the worst, did not take account of price rises over the years, and did not listen to anything the owners said. And again, the appeal was allowed. What that shows is that in most businesses where you have good records, just because HMRC makes an assessment does not mean that it is the final word. If you have the records to show that this is unreasonable, you should be able to argue back on an investigation and save you and your clients a great deal of money. At that point, many thanks. If you have any questions, that's my email address, jpmind20@gmail.com. Otherwise, if you want anything in the chat box, now is the time for any questions. Otherwise, I look forward to speaking to you on a future occasion. If there are any questions, now would be a good time. Final chance, if anyone wants to put anything in the chat box, if they have any questions. I've got a Q&A. Say, it's impossible to cover the whole of compliance, but I have hopefully given you a few highlights of things to think about in the future. Okay, thank you very much. I had no further questions. So I wish you all a very pleasant weekend.